Hey guys, how's it going and thanks for coming. I'm Nick, and in this video we're going over if it's stock buying time, because I'm sure a lot of you are looking at the stock market. Stocks are looking a little cheap. Things are definitely going on. So could this be a time to buy? So we're going to be looking at some growth, going to be looking at some dividends and diversification as well. But also be aware at the end, there is a warning. Some people might not care, they might not watch it, but I know you could be a little different. So stick around till then. Disclosure, I'm not a financial advisor, so remember to do your own research into investing. So let's start it off. With number one is oil. So I'm going to kind of take a macro view on things. I'm not going into like Apple stock. I'm looking at certain assets or sectors. So then we could look into a little bit further if you're interested. But first we could definitely look at oil, because oil used to be $60 a barrel. And now, I mean, it's still very volatile, so beware of that. But it did get cut in more than half. Right now it's around $25 a barrel. So I'll show you a quick chart. It is April 8th on Wednesday, so just beware of that date. But this is the year-to-date chart of oil. So it's actually a little bit less than 25 at this point, but it's just been moving drastically every single day. But you could see it start out in the 60s and now it's much lower. So this could definitely be a speculative type of play. No one really knows what could happen with oil. You know, a lot of the oil companies, they're obviously not making as much of a profit as they were at $60. At one point, I forgot how long ago, it was definitely a while, maybe last year, a couple years maybe, but it was $100 a barrel. So they're making a lot less. So that could be a speculation to get growth, but also to look at dividends. You could look into individual oil companies. So there's always ExxonMobil and Chevron. So you could certainly buy those companies as well. Do your research, of course, but they have dividends. Now beware, although their dividend yields are high, because of this drop in oil price, they're not making as much, so there might be dividend cuts as well. Now, quick extension from oil, there's also just the energy sector as a whole. So this is an ETF mirroring that. You could see a huge yield, but just beware, they might be cutting that at some point. You know, it's just speculation right now, but everything is very low. It was a bit lower mid-March, so just something to look at. And last thing for number one, I want to throw a little bit of research in there for you with oil. So you could see this chart back to, it was 1946, and you could see this is inflation adjusted. So in the beginning of the chart, it was pretty low, then it completely skyrocketed in 1973. The reason for that was because there was an oil shock and there was gas shortages due to an oil embargo of the United States. So you could see back to the chart, inflation adjusted, it dropped all the way back to, I mean, the last time it dropped this low was around 98, and the last time before that was in 73. So technically, oil is really, really low right now. But if we take off inflation adjusted, this is just the price in general. And right now you can see last recession, it was over 100 and it crashed, very similar to right now, to more than half, around in the $40 range. Moving right along to number two is gold, something I've been watching very closely over the past maybe year at this point, especially in the past few months, and I want to show you exactly what's going on with gold. This isn't gold. I wish it was. It would probably weigh like 20 pounds. But let's look at some gold charts. So this is going back to 1973, and you could see it completely skyrocketed in the 80s. Then it kind of lulled for quite some time. Then there was a huge bull market from around like 2000 and shot way up until 2011. Then it came right back down, and now it's starting to make new highs. Now at the same time, we could also look at silver. It does somewhat mirror gold, a lot more volatile though. So you could see in the 80s, completely shot up, then it lulled for a while, then it completely shot up again in 2008, And right now it actually hasn't moved yet, at least much. So I'm putting gold for a couple different reasons. One, because it definitely diversifies your portfolio. If you are a fan of Ray Dalio, he says you should have a portion of your portfolio in gold. If you don't know anything about history, because gold maintains its value. It maintains your wealth. So when stocks go down, you could see in the charts before that gold went up, especially if there's a lot of inflation. It's not really that gold is going up, is your dollar is going down. So some tickers to look into, one very popular one is GLD. This is all paper gold technically, it's all traded, but you can invest gold that way. Or another one that I look at is IAU. So that kind of mirrors the gold spot. So if gold gets more expensive, it's kind of difficult because this is just paper, while premiums, which we're going to talk about in a minute, but those are tickers that mirror the spot gold price. And there are silvers. Silver is SLV, so you could look into that as well. Now, there are also minor stocks in the gold industry. So if gold goes up, then gold miners go up even more. So it is more risk, more speculation, but something to think about. So this is definitely growth and diversification. So one popular one is GDX. That is gold miner ETF. You could definitely follow that. Another one which I follow is Ring, R-I-N-G. So we could start looking at a couple of charts right there. This is IAU. This expense ratio is a little bit less than the GLD, so that's kind of why I look at it a little bit more. The expense ratio is 0.25. The GLD is 0.4, so it's a little bit cheaper in that perspective. But you can see this chart, it had a bull market since 2008, then it fell a little bit, and now it's starting to pick up more. You could also see that it's been up year to date over 8% when the market is down. Now we could also look at gold miners. This is RING. I look at this over the GDX because, again, with the expense ratio, this is just 0.39 when GDX's expense ratio is 0.53. So a little bit different there. So you could see in this chart, it was at all-time highs right after the recession, and then it came back down for quite a while. It is down year to date, not as much as the market. However, this is a way to diversify as well. Quick side note, premiums, because a lot of people are starting to buy gold and silver because they're getting a little unsure. It's very difficult to buy physical gold and silver right now. Their premiums, I heard gold is between like $100 and $200 extra an ounce, and silver is an extra like $5 to $10 an ounce. Coming up on number 3 stocks that you might be able to look at are REITs, real estate investment trusts. Now they're down even more than the overall market. Reason behind that is because when people get unemployed and they lose their jobs, then it becomes more harder for them to pay their mortgage, pay their rent, or even small businesses to pay their rent on their buildings. So one ticker symbol you could look at is VNQ. So we could look at their stock chart real quick. This is with Vanguard, and this is an ETF. So this holds a bunch of REITs within this. Now you can see this overall yield is 4.5%. So it is a little bit of a higher dividend than some normal stocks. For tax reasons, just realize it's considered normal income most of the time. But you can see that it's down around 30% when the market is up a little bit more than that. And it definitely is a low expense ratio. Now that the picks that we're going to continue on with, including this one, just be wary, look into this a little bit further, because this could certainly just be the start of things. Over 10 million people have applied for unemployment, and this is probably not the end of it. This is going to continue, so this could certainly get hit more. So that's part of the warning. At the end of the video, we're getting there. So this is a way to get more dividends because their dividends are very high, a way to diversify as well. So one big company a lot of people love is O. That's a ticker symbol, and that is Realty Income. That's because it has monthly dividends. It has been rebounding for the past couple days, but its yield is over 5.5%. Going on with the fourth type of stock you could look into are dividend stocks, and I'm going to show you, like we said before, with ETFs and kind of a broad macro market look. So some of the tickers I'm going to show you is VIG, the other is VYM. These are some big ETFs you could look into, and I'll show you why. Because one, of course, it's Vanguard. Everyone loves Vanguard with their low expense ratios. Now, the VIG is dividend appreciation, and you can see their yield is around 2%, and the VYM is high dividend yield, and that's around over 3.5%. So again, be wary of these because these are more attached to the overall market. It's not really diversifying away from stocks. So if the market gets hit, these are going to get hit along with it. However, these could definitely be ones to keep an eye on, especially with their dividend yields, because they hold companies like the banks, or Johnson & Johnson, or Procter & Gamble, and big companies like that that have large dividends. So instead of just picking one, you could have all of them. Interestingly enough, I looked into the history of how these two reacted, and this has a lower dividend, yes. However, because it's more dividend growth and appreciation, it has growth behind it as well. So it actually rebounds faster than just these types of companies because it's more stable growth, and this kind of rebounds and has dividends at the same time. Now, the fifth thing we want to go into is more diversification with bonds, and I put an asterisk there because we got to be wary of them right now. The Fed is pumping just trillions of dollars into bonds. They're just skyrocketing. So what happens if that doesn't work anymore? It could certainly drop. However, one strategy I want to talk about after this, but one thing we're going to look into is IEI. IEI is a midterm bonds. So you can see here it's with iShares 3 to 7 year yield. This yield is around a 1.85%, and you can actually see year to date is up. So the strategy that I use to create one portfolio is that when you have a stock versus bond portfolio, if you have like a 50-50, that risk isn't split down the middle because stocks are more risky. So for example, if you have a 25-75, you have more bonds because stocks are more volatile. When stocks go down more, bonds, in theory, like we saw with this one, go up. So it actually kind of breaks even. So that's one that's kind of been taken off because of all these buybacks is TLT. That's long-term bonds. Just be wary with that because that's actually at all-time highs. And normally when bonds like that spike, there's usually kind of a drop-off after that. So beware, this is just a way to diversify. I also want to show you the performance of this medium-term bond fund is that last recession, it actually went up in 08, then it only went down a little bit in 09. So you could see it actually never really lost serious money, and that's why I'm showing you this instead of maybe a longer term bond fund, because those are a little bit more risky. Warning time. So obviously no one really knows what could possibly happen, especially with just trillions of dollars being pumped in the market, and you could see that with this recent rebound. It's not a small rebound as well, but that's also what trillions of dollars could possibly do to the market. So what if that doesn't stabilize anything? You know, what if whatever the Fed is doing doesn't work? And that's why I want to put a word of caution, because these stocks to look at could definitely go back down. But at the same time, diversification is a big one. So when people are they're looking to buy more stocks, let's say, when they got slaughtered, when stocks crashed last month, past few weeks, if you get more stocks and you didn't like losing money and you buy more stocks and nothing else, then you're going to get hit again the same exact way if stocks continue to drop. which is why I did another video comparing the recession in 2008 to now, because there are a lot of similarities with the Fed, a lot of stimulus, unemployment, and there's just so much debt in the system that I really don't think the bottom is in. I'll try to attempt it, but what happens is that it kind of drops, then it rebounds a little bit, then it drops more, and it rebounds a little bit, and it drops more. So it's not just a continuous drop. Nothing goes up or down in a straight line. So, you know, we might be at that type of point, so just be wary of that. The main thing is to look at your risk tolerance and your time horizon. So if you have a long time horizon and you have time to wait for things to go back up, then, you know, if you kind of build a position on the way down and maybe, you know, on the way up, or whatever your strategy is, you could certainly do that. However, if you have a shorter time horizon or you're trying to save for something in the near term, this might not be a good idea because it could certainly go down lower. Now, what I've recently done is because I have a longer time horizon, which a lot of people might have as well, what I did is I kept my core positions, because I'm just going to hold them forever basically, but at the same time I started trimming back some of the things that I made recently. I wanted to get out when I was up, so I sold some smaller positions to gain some cash, and I also diversified more. So instead of having just all stocks, diversified into, let's say, like we talked about before, with some gold too. So that's just me personally. Remember to do your own research, look into things deeper, and we could learn a lot from history. So I would definitely recommend checking out that video looking in at last recession, because things are very similar. Not exactly, but very similar. And the fact that this might not be over because unemployment is just starting to be spiking. And what the Fed is basically doing is trying to keep everything up and stabilize everything. And what if that doesn't work? So it could certainly start rebounding, but for me personally, I'm not putting any more heavy money into the market. I think one main question to really ask ourselves is, what if we're wrong? What if this doesn't rebound like every other time? A lot of people aren't thinking that this is going to be a V-shaped recovery. It might lull out for 10 years. So you can't dismiss that. What if that does happen? So definitely keep all of your doors open, which is exactly why I gave a lot of different options to possibly invest in. So if you guys have any questions, comments, concerns, please leave them down below. I'd love to hear what you guys are doing in this market. Are you just hoarding cash like Warren Buffett? Are you starting to buy a little bit more to build your position? Or whatever in between? So let me know what you guys are doing. Hopefully this helped you. Hit this video with a thumbs up. Don't forget to subscribe for more videos. And I'll see ya in the next one.